Did you feel your wallet get heavier this month? It's not just your imagination. The new CPI report just dropped, and the news is far from good. If you thought 2024 was an expensive year, brace yourself, because 2025 has already started off on the wrong foot. Inflation jumped 3% in January, leaving everyone, from Wall Street investors to the guy who just wants to grab a coffee without spending a fortune, completely on edge. And don't think this is just some meaningless number. The CPI is basically the thermometer of your cost of living. When it goes up, it means that every trip to the grocery store, every bill at the end of the month, and even every weekend outing is going to hurt your wallet just a little more. Before you panic and start stocking up on instant noodles, let's break down what's behind this increase, and, more importantly, how this could either wreck or save your money in the coming months. What is the CPI, and why should you care? If you're not an economist, you've probably never stopped to think about what the CPI report actually means. But here's an uncomfortable truth: it affects your life more than you realize. The Consumer Price Index, CPI, is nothing more than a giant shopping cart that the government keeps track of. It monitors the prices of almost everything you use daily: food, gas, rent, healthcare, even that coffee you grab every morning before work. Imagine this shopping cart had a price last year. If the CPI goes up, it means that today, that cart costs more. And guess what? It's now 3% more expensive compared to January 2024. That might not sound like much, but when you stack this increase on top of everything that has already gone up in recent years, well, you don't need a calculator to see the damage. And if you still think this doesn't affect you, here's an interesting fact: the higher the CPI, the harder it is for the Federal Reserve to lower interest rates. And what does that mean? That your mortgage, car loan, and even your credit card interest rates could stay high for even longer. Who's to blame for this inflation mess? Whenever inflation spikes, the first question on everyone's mind is, who's responsible for this disaster? First off, food prices are still rising. If you felt that your breakfast has gotten more expensive, it's not a coincidence. Staples like eggs, milk, and meat are eating away at budgets, and not by accident. A bird flu outbreak sent egg prices soaring, while supply chain issues continue messing with the cost of other essentials. Another major culprit: the housing market. The cost of housing refuses to go down. Rents keep rising, and the dream of homeownership is slipping further away for those needing a loan. And remember what we said about the Federal Reserve keeping interest rates high. As long as that doesn't change, home prices will stay sky high, because banks aren't being generous with loans. And last but not least, there's the invisible but powerful force: market expectations. When investors see inflation staying strong, they start betting against rate cuts. This forces companies to hold back investments, raise prices, and pass those costs down to consumers. In this case, we're stuck in a cycle where everything affects everything else. And getting out of this mess won't be easy. What can the Federal Reserve do now? So the big question now is, what can, or should, the Federal Reserve do to fix this situation? The Fed has two main options: keep interest rates high for longer to try to bring inflation down, which means loans stay expensive, credit remains tight, and people spend less. Cut interest rates to relieve businesses and consumers, but risk inflation spiraling out of control again, making everything worse in the long run. Guess which option the market was expecting? That's right, rate cuts. Many economists predicted that the Fed would start lowering rates in the first half of 2025. After all, prices were slowing down, and everything suggested that the worst was behind us. But then, this brutal CPI report came out, and those plans went down the drain. The Federal Reserve is under massive pressure. If it keeps rates high for too long, it might push the economy into a full-blown recession. If it cuts rates too soon, it could send inflation soaring again. We now understand that prices are rising, the Federal Reserve is stuck in a tough spot, and the market is a mess. But the real question is, what can you do to avoid getting crushed by this crisis? The first thing you need to know is that, in times of economic uncertainty, cash is king. Avoid unnecessary debt. With high interest rates, any debt you take on now will be even more expensive in the future. If possible, hold off on big purchases and avoid long-term financing. 2. Cut unnecessary spending. You don't need to live like a hermit, but analyzing where your money is going can make a big difference. Small cuts in subscriptions, dining out, and impulse buys can help. 3. Invest wisely. During inflationary times, letting your money sit idle is a terrible idea. Investments like Treasury inflation-protected securities, TIPS, or assets that historically hold up well during crises might be smart options. The truth is, the economy is a machine with moving parts that can come together or fall apart at any moment. And inflation is just one of those parts. What we're seeing now is a perfect storm of factors, from monetary policy to global supply chain challenges, all hitting our wallets directly. The Federal Reserve might try to keep inflation under control with high interest rates for a while longer. But can they do that without killing economic growth? And what if things suddenly start to improve? No matter what happens, one thing is certain: big changes are coming, and the market will react. The trick to surviving all this? Keeping your eyes open and staying prepared for whatever comes next. That's why, now more than ever, it's crucial to stay informed, understand how the market works, and make financial decisions with extra caution. The game isn't over yet, and those who prepare now will have the upper hand. And finally, what do you think about all this? Do you believe inflation will keep rising, or are we finally seeing the end of this economic nightmare? Drop your thoughts in the comments and don't forget to subscribe to the channel for more breakdowns like this.